Hey, in this video, I want to discuss something that I find very fascinating. And this is a concept that was introduced to me by Al Brooks, um, probably a year ago, six months to a year ago, and just in theory. And as I've started to become more consistent watching the markets every day, it's something that I've actually noticed play out in practice. And I think it has some pretty interesting implications for trading. So I wanted to discuss that in this video. The concept that Al Brooks talks about is it's essentially pattern recognition, but it's that sometimes the market gets into a short-term pattern of repetition. So instead of patterns playing out over the long term, maybe months and years, they actually happen day to day as well. And sometimes they get caught happening in consecutive days. So what happened yesterday that pattern might actually play out the next day, and sometimes it has a greater likelihood of happening in consecutive days because market behavior is similar. So if there's fear in the market on Monday, there might also be fear in the market on Tuesday, and it might play out to be a similar pattern. So here's an example from November 14th, I believe it was Tuesday, and I didn't get any trades here, but I was watching it play out and it was something that I wanted to share. So here you can see that we had a trading range to start, but we had a quick sell-off on the open, and that sell-off reversed immediately all the way back to a new high and entered a trading range. And that trading range happened to hold above the open of the day. So this is the open of the day, the open of the first bar. So the trading range held above the open of the day, and then we got a false breakout here closer to the second half of the day. It was a failed breakout because it ended up breaking back above it and holding above it for the rest of the day. So we got a rally, but it was pretty much a trading range for the rest of the day. And the same thing started to play out the next day. So as soon as I see this, I've been seeing it a lot more often over the last few months, but when I see this, I remember what Al Brooks said, and I started to pay attention to it. So here we started with a gap down. This is November 14th, the Tuesday. Gap down, quick sell-off, and then the rally. And then I saw it November 15th, and as soon as I saw a gap down and a quick sell-off, I remembered what he said and started to look out for it. And it turns out to be pretty fascinating when you start to see it play out in real time. So here we had gap down, quick sell-off, a quick rally back up to a new high, where the trading range holds above the open of the day until the second half of the day when you get a false breakout here, and then you get back above that open of the day for a rally. And in this case, we ended up closing below this line, but we still ended up in a trading range for the second half of the day. And that's really interesting to me. And it's not just today. I'll show one more example of this, and then I'll share my interpretation of the implications of this for trading. So another example happened April 7th, 2016, and there are many examples in between, but these are the ones that I've found from the charts I've been studying. So on April 7th, we had a quick trading range, but it was followed by a quick sell-off, and then we had three clear pushes down. So one here, another one here, and a third one here. So 1, 2, 3. So we had three clear pushes, and at that point, the market had to make a decision to either rally into the end of the day or to break below those three pushes and get a sell-off like we did. So we ended up getting a sell-off here. Now let's look at, so this was April 7th. Now let's look at April 8th. So you can see a bit of it here. I'll just zoom in. So here's April 8th. So here's the tail end of April 7th right here. Now we'll look at April 8th. So we had an opening trading range. This was a bit longer than April 7th. But then we got a quick sell-off here, followed by three clear pushes. 1, 2, and 3. And after those three pushes, the market had to make a decision. It can either rally up. It tried to rally, but it failed. And we ended up getting a sell-off to a new low into the close. And here, same thing. We had to make a decision. Ended up selling off to a new low. into the close. And actually, what's even more interesting is that the next day started to follow the pattern of April 8th. So you can see even from the beginning of April 11th, April 8th was a Friday, April 11th was the Monday. You can see that here we had a gap up, strong rally up, and then sell off. And April 11th, we had a gap up, strong rally up, and then a sell off. So April 8th was kind of mimicking April 7th, and then April 11th was kind of mimicking April 8th. And so in terms of the implications for trading, I don't know if they're beneficial for real-time decision making, so looking at the prior day and trying to make decisions based on yesterday's price action, but I do think that it's important because it reinforces the fact that these patterns do repeat themselves. And if they repeat themselves in 2 consecutive days, they're probably going to repeat themselves again in the future, maybe 2 weeks from now, maybe a month from now. And so understanding how these patterns play out, I've found was really helpful for me to try to gauge what the market is going to do next. And obviously it doesn't provide certainty, but it definitely gives you an idea of what could happen next. So just wanted to share some of those thoughts with you. And if you found the video helpful, let me know in the comments. And thanks for watching.